Welcome to This Explainer. We're diving straight into a massive macro mystery that is frankly driving Wall Street a bit crazy right now. For months, the market has been eagerly pricing in aggressive interest rate cuts. Yet day after day, those rates remain stubbornly high. Well, today, we're breaking down a huge recent development, the Fed's leaked June playbook. This leak actually reveals exactly why those rates aren't dropping, what's really happening behind closed doors, and most importantly, what all of this means for your money. So think about this core contradiction for a second. The market was absolutely 100% convinced that relief was coming. I mean, they had priced in a massive 97.4% probability of a rate cut at the June meeting. But instead, the central bank held steady. And not only that, they suddenly dropped their future economic forecasts altogether. You have to ask yourself, why would they completely blindfold the market right at this exact moment? Look, there are basically two completely different storylines happening here. The official story they're telling us is that inflation is running hot at 4.2%, it's incredibly sticky, and the Fed just has to stay tough to fight it. But our sources point to a very different, unofficial story. The working theory is that the Fed is actually secretly preparing a stealth quantitative easing, or QE. Basically, they're getting ready to print money without making it look like they're printing money.
All right, let's get right into part one, the Fed's leaked playbook. This whole thing kicks off with a sudden, major shift in communication. The Fed is officially dropping what's known in the finance world as forward guidance. By definition, forward guidance is just how the central bank communicates its future plans to bond investors, so those investors can place their bets with confidence. By abruptly refusing to share their forecasts, the Fed is effectively blinding bond investors to their true next moves. Now, sure, this creates massive market uncertainty, but it also gives the Fed total flexibility to pivot whenever they want without being accused of breaking a promise.
And to go along with that sudden radio silence, they're actually changing the math. The Fed has reportedly launched 5 task forces. The third one, specifically, is designed to evaluate new data sources and literally change how the economy and inflation are measured. According to the strategy outlined in our sources, this involves potentially removing extreme outliers, like highly volatile oil prices, from the inflation data entirely. Think about it. If you change the underlying data to exclude the very things going up in price, while you can artificially justify lowering interest rates later while still claiming to be completely data-driven. Which brings us to part 2, the stealth QE machine.
Guys, this is essentially a giant financial Rube Goldberg machine. And here's how it plays out in 3 steps. Step 1, you keep rates high today and drop that forward guidance so you look really tough on inflation. Step 2, you publicly shrink the Fed's balance sheet by selling off bonds, which looks like highly responsible tightening. But step 3 is where the magic trick happens. They loosen bank regulations to allow commercial banks to swoop in and scoop up those exact same bonds. So to really grasp this, we have to understand that specific regulation. It's called the SLR, or Supplemental Leverage Ratio. It's a strict post-2008 financial crisis rule that limits how many treasury bonds a bank can hold on its books relative to its actual capital. Now remember back during COVID in 2020, the Fed temporarily exempted treasuries from this rule, and banks instantly piled hundreds of billions of dollars into the bond market. The leaked playbook suggests they might make that COVID-era exemption permanent. That would free up commercial banks to buy massive amounts of government debt using huge leverage.
The reality of this setup is pretty stark. As our analysis reveals, and I quote, "It's basically quantitative easing, aka money printing. It's just laundered through the commercial banking system." By doing it this way, the Fed can stand at the podium and claim they're strictly shrinking their balance sheet to fight inflation, all while quietly allowing commercial banks to act as the actual money printers on their behalf. Honestly, it's a brilliant if highly controversial workaround. Moving on to part 3, the geopolitical oil roadblock. Okay, so right now, inflation has spiked back up to 4.2%. And a huge driver of this is the geopolitical conflict in the Middle East, specifically the threats to the Strait of Hormuz, which controls roughly 20% of the world's oil supply. We have to remember that all wars throughout history are structurally inflationary. If oil prices stay high, inflation absolutely stays high. And if inflation stays high, the Fed never gets their golden excuse to cut rates, and their entire stealth QE machine just breaks down.
But here is where the timeline gets genuinely alarming. The United States Strategic Petroleum Reserve, which is that emergency stockpile acting as a cushion for our domestic gas prices during global shocks, allegedly runs out in less than 80 days. Once that safety net is gone, there is literally nothing left to artificially suppress oil prices.
If global supply chains are still messed up when that reserve hits zero, we could be looking at a massive, massive inflationary shock. And honestly, the timing here couldn't possibly be worse. Over the next 12 months, the US government has to sell or refinance a staggering $8 trillion worth of government debt. They desperately, urgently need to find buyers for this debt. But if inflation is surging because of oil, investors are going to demand much, much higher interest rates to lend their money. That makes managing that $8 trillion drastically more expensive for the government. That takes us to part 4, the bond market revolt. The reality of this rebellion really just comes down to pure math. The Fed desperately needs what we call a steep yield curve. That's where long-term interest rates are much higher than short-term rates. In a normal, healthy economy, the profit spread between a 2-year and a 10-year Treasury sits around 1.0 to 1.5%. That healthy gap is exactly how banks make their money. But because of the current crisis, short-term rates have spiked, absolutely crushing that spread to a meager 0.4%. Banks simply won't buy long-term bonds, risking their capital for 30 years just to make almost zero profit. It makes no sense for them.
To make matters even more complicated, we have to look at who is actually buying U.S. debt right now. Our old, reliable buyers, foreign central banks, largely stopped buying U.S. Treasuries way back around 2014. So who stepped in? According to Federal Reserve data, highly leveraged hedge funds based out of the Cayman Islands have bought roughly 37% of all new government notes issued since 2022. This setup is incredibly fragile. If the stock market takes a hit and these heavily leveraged funds get hit with margin calls, they're going to be forced into sudden, massive sell-offs of U.S. Treasuries. That could potentially collapse the bond market entirely.
Finally, let's look at part 5, actionable investor takeaways.
So you need a way to track whether the Fed is actually pulling this stealth maneuver off. Our sources point to a super helpful 5-point scorecard. If the Fed's plan is working and liquidity is quietly entering the system, you should see a weaker US dollar, higher stock prices, lower 10-year Treasury yields, and higher prices for hard assets like gold and Bitcoin. But if you see the exact opposite, which actually happened recently, when the dollar went up, stocks fell, and yields rose, it means the market is rebelling and the Fed's plan is failing. Watch these 5 metrics closely. They are your early warning system.
Ultimately, if this leaked playbook executes successfully, we're looking at an environment where the money supply quietly expands, which structurally drives up your everyday cost of living, even if the official data is telling you everything is perfectly fine. So I'm going to leave you with this absolutely crucial question to think about today. How is your portfolio positioned and hedged right now against the next potential wave of hidden inflation? Thanks so much for tuning into this explainer, and make sure you stay focused out there.